Good morning. Let's look at chapter 20 and chapter 21 of our book, and then we'll look at a couple of extracurricular activities that I've got in D2L. One is an Excel spreadsheet on how to prepare a very simplified flex budget based on actuals. So we'll look at that, and I'll tell you what you need to do as far as that being a part of your assignment for next week. And also we'll look at an article. Let's run out an article. It's a list of Deming's 14 points and his 7 deadly diseases. This is what drove the United States when they started helping Japan after World War II, and was pretty much ignored here until sometime in the 80s. And from that point forward, this is the basis for all of our continuous improvement throughout America, as well as which includes both throughput that I've talked about, as well as process variation. So we'll look at that briefly here at the end. But first, let's just go ahead and look at chapter 20. And let me see if I can pull up the text for that that Alex sent me. There we see it. Let me see if I can make that a little bit bigger. I'm not exactly sure how large I made it last time. Where's my large? I don't see, where is it? How to make this larger? That's search. There it is, finally pops up. All right, so performance measurements and trends. Now that first paragraph there says a lot. It's talking about looking objectively. Here we are on page 356. Looking objectively at the strengths and weaknesses, and must understand the interrelationships there, the functions of the organization. That's so important as a controller, as a financial leader of your organization. It says an important part of this knowledge revolves around the information provided by those ratios that describe the conditions of the business, as well as the trends of key operating statistics. A lot of companies call those KPIs, key performance indicators, or metrics is another term that's used and thrown around a lot. But these performance measures are very important. Down at the bottom, it says, in general, emphasis should be on detailed analysis by the controller and on simplicity. You've got to make it simple. I can't tell you how many times I've had to do a one-page summary. Maybe I've got 40 pages of analysis and supporting documentation. But so many of these people higher up in the organization, they want to see it on one page, especially the non-financial people. They want to look at the detail. The only one's going to look at the detail is probably going to be your engineering types and your financial types. The only one's going to look at the detail. But you've got to get that simplified to get your point across. And that's a great point on a resume as well. I mean, when you're putting a resume together, no matter how long you've worked, you need to get the most important stuff on the front page. And you starting out in your career, you need to have one-page resumes that is very clear, very structured, clean. I always think of Google and how simple their screen is, right? That main screen you log into. That's where your resume should look. It shouldn't just have your name on like Google, but it should be very simple. And you need to strive to do that. And so that's very important there in what we read in that very first paragraph. But it sounds like what they're referring to there is what we learned in that Skills of an Effective Administrator last time, with what? The conceptual side of things. The big picture is another term, the 35,000 foot view. But it's really more than just that. You want that large view, but you need to understand how all these detailed components and submodules and so forth really are integrated to be used. But really, you've got to be thinking conceptually as you progress in your career, not just from employee relations skills and even backing up all the way to the technical skills, by learning each of those progressively as you move through an organization. Next page, profitability measures down there at the bottom. I mean, we could spend hours talking about this. Most of this you've already had. Return on sales, gross profit to net sales. I know when I teach 2020, I have an Excel assignment where we do I think some 21 or 22 formulas there for analysis after downloading the balance sheet and the income statement and some other information like market price of the stock. It's a great exercise in 2020. Sometimes I think we ought to do that again in 3020 and again here in this class, because a lot of the stuff is pretty basic. But they break this down into the various areas. The first is profitability measures. There on page 358. Return on net sales, pretty straightforward. Return on or gross profit to net sales. Operating margins. Look at the percent return on assets employed. Why is that important? Net profit to total sales. Well, that's why you employ assets. That's why you take your cash and spend that on your CapEx. So important. We've talked a lot about CapEx in this class. Very important. So you want to see what is your return on your total assets. See, some of those assets you own, some of those you owe money on. You may have a mortgage on or a loan. So it's important to look just at total assets that you've employed. Are they generating the income that you want? And a lot of times you look beyond that as impairment. Remember back in 3020 when we talked about impairments there on your assets, whether they're intangibles like goodwill or a patent or copyright, looking at those and doing the testing on that, as well as on property, plant, and equipment or fixed assets. And when the cash flow, future cash flows, the undiscounted future cash flows are less than the book value of your, whether it's goodwill or copyrights or property, plant, and equipment, when that cash flow is less, then you've got what? You've got an impairment. You've got an asset on your books that's going to generate less income or less cash flow, not income, less cash flow than what it's worth. So you've got impairment, and then you have to write it down to fair value, right? Fair market value of whatever the goodwill. Of course, goodwill is a little bit different how we handle it, but the other intangibles as well as property, plant, and equipment. Good to back up and look at that, especially when I know you're studying for the CPA, and try to emphasize some of those items. You can read that on your own. If you look at the next page, and I like how they do this, he really goes into the detail here, right? Return on assets. See how important that is? He understands. He's a controller. He understands you're spending, as much as you're doing the operating budget every year, you've also got your CapEx budget. And he's talking here about your return on those assets that you've employed, that you spent cash on to drive revenue stream, right? And so he's looking at that and relating how you come up with the turnover on your assets. That's related to your total assets in relation to sales, right? There's a lot of different turnovers. You got turnover on inventory, a lot of different things there. But here we're just talking about total assets, which inventory is just a part of that. And look down at the bottom is earnings ratio. So back up into all of this and see how this is flowing through on one side, the turnover ratio as well as the earnings ratio to calculate your return on assets. Really good chart there that shows how so many different things, so many different fingers going back to those feeder systems and their relationship and how that impacts return on assets. Very important. All right, continuing on. Like I said, we're gonna go through this fairly fast. Y'all are doing a great job, by the way, on your weekly papers. Hopefully you're getting in your mind what you want to write about in your final paper. And it's okay to take, of all those papers you've written this year, it's okay to take stuff you've already written, because the majority of you have done a really good job of personalizing it. And when I look at that Turnitin similarity index, some of you are at 0, which is just incredible to me. Usually they would run 5 to 10%. Some of you are like 0 and 1%, which means you're writing all of this, at least as far as I can see. It's never been turned in before, and Turnitin does a pretty good job. So that's great. And if you want to borrow from some of the stuff you've already written, that's okay. I'm not going to come back and say, well, you wrote, what did I say, 12 to 15 pages or 4,000 words, whatever it was. If you want to borrow from stuff you've already written in your words and put it, that's fine. for whatever topic that you decide to write about. That's fine, because I know it's a lot of stress right now, a lot of pressure here at the end of the semester trying to get all this stuff done. I know you're taking all these other classes, whether it's financial or tax. So borrow from what you've already done if you want to. And if you want to, so don't think I'm going to look at what you've already turned in and compare that to this 12 to 15 page paper, whatever you write. Now, don't make all of it like that, but you can borrow from that. There's nothing wrong with that, because that shows you've learned and you've remembered that. All right, continuing on here, measures of growth, percent increase in sales, percent increase in net income, percent increase in earnings per share. It always reminds me of back in 2020. If you had me, I focused a lot on horizontal analysis. I had to think a minute. Horizontal analysis and trend analysis. Remember what those are? Horizontal, what it sounds like, going across really year to year or month to month or period to period. What was your net income last year? What is it now? On the income statement, that applies to your balance sheet as well. What is your cash last year? What is your cash now? That is horizontal analysis, year over year or period over period. He doesn't mention that here, but that's really talking about growth or decline as well if it's going down. And then the other part of that is your vertical analysis. And I'm writing this down because it helps me to articulate this better. Vertical analysis. That's north and south, right? That's when you're taking your balance sheet, for example, and show what's the relationship between cash and total assets? What's the relationship between intangibles and total assets? What's the relationship in each of your assets and total assets? And then on the right side of the balance sheet, where your liabilities and equity are, you're comparing each of your balances there with the total liabilities and equity, just like you did total assets. And so that is a vertical analysis that you're looking at. And then of course you can do horizontal analysis on that. Well, what was it last year? What was your vertical analysis last year? And then the other one I think they talk about later in here is trend analysis, but we'll get to that here in a second. So those are measures of growth. What about this liquidity measures? Current ratio, quick ratio, remember the difference in those? Current is that current assets divided by current liabilities. Solvency, it's another term there, liquidity. And I like to use the term solvency because it sounds like what? You might be in trouble. And then the quick ratio typically just backs out inventory for reasons we've talked about before. And so there's a list of those liquidity measures on page 361. The one they don't have here is one that I always talk about in 2020 and 3020 is working capital. And working capital is defined as current assets minus current liabilities. So where the exit's a dollar amount instead of a ratio, it's a dollar amount. How much working capital do you have left over? And companies use working capital very loosely. A lot of times non-financial people will use that to talk about inventory only. But working capital defined is current assets minus current liabilities. And you see a lot more ratios there as well. Cash ratio, there's working capital to debt ratio, but then they're using just specific account titles there. A lot of stuff there. And whatever industry you get into is going to, you're going to use whatever they're using for their particular company. You're probably not going to reinvent the wheel unless you're an entrepreneur. All right, keep going there on 362 is debt measures, debt ratios. Always important. Debt coverage. There's an interesting one. Times preferred dividends earned. I don't think I've seen that before. A lot of analysis there. Gives people jobs, right? Next page, activity measures. Receivables turnover. Why is that important? You want your receivables turnover to be as high as possible, just like you want inventory turnover to be as high as possible, right? Very important. And asset turnover. You want all those to be high because that means you're really employing that. And here with receivables, and then when you take your receivables turnover that they've got there, they don't actually show the days of receivables, does it? So when you get your receivables turnover, you want to what? Divide that into 365. or excuse me, 365 divided by your receivables turnover will put it into number of days. So if your number of days after calculating receivables turnover, if you just assume a 365-day year, tells you how many days is the average accounts receivable. How old is it? Is it 28 days? Is it 27 days? Is it 33 days? And what was it last month? What was it last year? Is it going up? Is it staying about the same, or is it going down? And then that encourages you to drill down as a controller into why those ratio, why that days of accounts receivable are getting more aged. And the older it get, the less likely you're going to be able to collect on it. All right, same way with inventory turnover. That's more of a function of, are you building the right product? Are you, well, I mean, that's probably the biggest reason. Are you building the right product to where you've got more on the shelf, or maybe you got stuff that's going to become obsolete? That's the danger there. Kind of like old receivables. It's not going to be collectible. The older your inventory gets, the less likely you're going to be able to sell that. Or if you got some perishable product, whether it's a Food City or Walmart or whoever, that stuff's going to spoil, right? It has to be thrown out. It has dates on it. It's the same way in battery manufacturing. Once you have good product that sits up there for 90 days or so, in the case of an automotive battery, if that battery's probably going to have to be taken off the shelf and boost, put a charge on it again. That's expensive. A lot of labor involved, more electricity, more chance to damage something. So it's very important. Your receivable inventory turnovers, payable turnover, you don't hear much about that, but that's where you want to extend the days as long as possible to manage your cash, right? So the opposite of accounts receivable, especially if your accounts receivable is not being paid. You don't have the cash coming in, well, you don't have the cash available to go out in your payables. And they talk a little bit about that on each of these pages. I say they, he, Mr. Bragg, or I guess he's a Mr. Stephen Bragg. I've got highlighted inventory turnover. Operating measures down there at the bottom. I know the last part of managerial accounting 2020 principles, we talked a lot about break-even points. And break-even point is where you want to find out what your contribution margin is. And what contribution margin is? What's your sales price minus what? Minus your variable cost, right? And so that tells you how much you are going to be able to contribute per unit to what? To fixed costs, to cover all those fixed costs being fixed and not variable, because everything's either variable or fixed. Subtract out your variable costs per unit from your selling price per unit. That tells you how much per unit you have to go against your fixed costs. And that tells you how many units you got to sell to break even. Very simple, very important, especially as an entrepreneur. You're trying to figure out how much monthly fixed costs do I have and how much contribution margin, because contribution margin is different than gross margin. Gross margin, remember, is your sales price minus what? It's your cost of your goods, both fixed and variable for each of those. So this is different. This is contribution margin, right? Maybe you're going to open up a Subway and pay for that franchise. You got your monthly lease, all your insurance, all those, and maybe your salaries. You look at that as being fixed, although that can be variable, right? You can cut people out if the business isn't there, but a lot of that you just consider like as a fixed cost. And then what are you selling your sandwiches for minus how much variable cost is going into each of those sandwiches. Tells you how much your contribution margin toward covering all those fixed costs every month. It's that simple and very effective. And then you figure out, of course, every sandwich has a different value, right? But just in general, they probably have a pretty good idea how many 6-inch or 12-inch subs they've got to sell. Then you throw in stuff like chips and drinks and what the margin is on that, the contribution margin is on that. Probably pretty high for stuff like that. It's probably more advertisement for Coca-Cola or Pepsi and all those various manufacturers of chips. So you can get a pretty good idea, and that's what he's talking about here on a larger level with break-even point. How much do you have to sell in order to break even each month? And then beyond that, that's when it's just pure profit from that contribution margin. So you're covering those fixed costs. Fixed and variable is so important that you understand that as an accountant and as a business leader at all levels. of businesses. Margin of safety, that's another 2020 term I can recall. Margin of safety is how much can it drop before you're in trouble. If you know what your expected sales are and what your break even is. So the expected sales versus your break even in sales tells you your margin of safety. All right. That's what he's getting at there. And there's those operating measures on top of page 365. He used a little bit different formula for break-even point. Like I said, there at the top, I always teach that as being fixed costs, which is probably what he's referring to as operating expenses, although that's a little bit unclear. Your break-even point is your fixed cost divided by your contribution margin per unit. Contribution margin per unit. That tells you how many units do I have to sell to break even. And if you take that fixed cost divided by your contribution margin in dollars, or excuse me, ratio, then that tells you what your sales dollars should be. Two different formulas. But fixed cost divided by your contribution margin. I'm not sure why he doesn't use that term here. Maybe he thinks it's anti-accounting, but it's not. Very important. You got to break out, you got to look at the cost behavior of what's fixed and what's variable. Very important. We'll see that when we look at that flex budget that I put together here. All right. A lot of stuff on that page. Next page. Ratio of sales returns and allowances to gross sales. How much of this stuff's being returned and why? Remember the 5 whys? Keep asking why to get to the detail. Look at that ratio of repairs and maintenance to fixed assets. Well, you spend a lot of money on repairs and maintenance, huge amounts. I can remember seeing $400,000 and $500,000 a month flowing through Bristol Exide just to repair the fixed assets. And of course, always making sure they're not expensing something that ought to be capital. That's a whole nother story. Can get really a gray line between what we think is black and white. It's not a black and white world. A lot of judgment calls. But that's interesting that they're showing that relation to fixed assets. Ratio of depreciation to fixed assets. Ratio of fixed assets to share, it's unlimited. Of course, a lot of stuff, once you get it set up, your formulas, if you're doing this in Excel, of course, most financial systems probably generate this for you, but sometimes companies have their own specific ways. They don't want to just use a vanilla software package. And a lot of times this stuff's downloaded to Excel, and then you can create whatever formulas, ratios that management wants to look at. But once you get that set up, and when you do the download each month or each week into a specific format in one tab, then you can just link that tab of where the download occurs into the tab where you're doing your ratio analysis. So once it's set up, it's simple, very simple. You don't have to reinvent the wheel every month. Cash flow measures, the bottom of page 366. Call it sufficiency ratios there, exhibit 20-7. Top of the next page. Dividend payout. Right, the cash statement itself is obviously important. Learn the 3 areas: operating, operating, investing, and then financing. 3 areas. You break down the changing cash, where you're really going from the accrual basis of accounting to cash basis of accounting. That's what that statement's all about. Taking accrual basis net income back to cash basis net income. That's what you're doing there. What happened to my cash? 368, then they're getting some really interesting stuff here. That's why I like this book so much. Non-financial measures. You think, well, what's that got to do with me? Non-financial, that's somebody else. No, that's you as well. Sales per employee, transaction error rate. That's very important, no matter what it is, whether it's payroll or accounts payable. What about employee turnover? Now, they don't put who's responsible for these, but what about employee turnover? That's usually an HR thing. Of course, you got to be careful. HR kind of uses some interesting accounting when they calculate employee turnover. And the other term is employee retention. But employee turnover, how many people left during the month divided by how many people did you start the month with? Break it down by department. And then try to drill down as to why. Is it because there's so much heat in that particular department in your manufacturing facility? Or is there an issue in another part that, I mean, that's just where you have to drill down and ask questions from people who are leaving. Exit interviews, usually people will be pretty honest about that. Sometimes they like to slam people, but you can get a general idea of why the turnover is high. Maybe your salaries aren't, or your wages aren't up to where they should be based on the competition. Sometimes you have to pay more. I know we paid more in Bristol than about any manufacturer around, except maybe NFS, because it was a difficult environment to work in with respirators in a lot of areas, and other areas you had to deal with wearing protective gear related to getting sulfuric acid on you. So you have to pay more for people to put up with that kind of thing. And some people don't mind. They'll put up with it in order to make more money. But in general, a lot of people won't. Dividend yield, stock options. I know how much everybody likes to talk about stock options. Look at the next page coming down there. Warranty claims percentage. Very important. You know, that's where you have to go back and make adjustments, change in estimates on your books when you've got more warranties being filed, because the accrual basis of accounting, you accrued that expense and set up the liability. When you actually sell the product, you have to do that. And what happens when the warranty claims start coming in more than what you had set up as the estimate? Well, you got to change your estimate in the current period and forward, right? Prospectively, as they call it. You don't retroactively go back. You do it in the current period and forward. So warranty claims, loan losses is another one. What's your percentage of loan losses? Bad debt expense, that's probably on here somewhere. Constraint utilization. We'll look at something there. I believe it's in the next chapter on constraint. Scrap percentage, very important down there. This inventory accuracy in general, obsolete inventory percentage, inventory accuracy, scrap percentage, by department, by product line. What about equipment setup time? Average equipment setup time, that's important. Is it equal to what your industrial engineer has set forth in the labor standards? Because those are baked into the labor standards. So you got to take that in consideration. It's unlimited, the number of things you can look at. And I don't say unlimited, I guess it's limited, but you know what I mean. There's a lot of stuff that you can do analysis on. All right, top of page 370. Again, they talk about transaction error rate. Time to produce financial statements. We looked at that fast close last week, didn't we? Time to produce financial statements. A lot of times you have imposed time limits to get that done at your plant location. And of course, they're on a timeline at your corporate office, pulling all these different facilities into one. And there it says, with the trend toward one-day financial statement issuance from a plant location and close the books in one day. Yes, you had to do that at Lear. That's a long day. XI wasn't quite that far along. They were 2 days to get your statements done at the plant level. I don't think they're talking about one-day statements at the corporate level. They probably have a pretty good idea, because the closing process really starts before the end of the month. So when you get to the end of the month, you're just kind of cleaning up. It's not just something that the month ends and oh my gosh, it's going to take forever to get this stuff done. You have to have this streamlined to where you're closing really, and we did a soft close every week in order to do our financial forecast of where we're going to end the month compared to budget and compared to the other forecasts that we would have put together. Human resource management down there at the bottom, or measurements. Employee turnover we talked about. They talk about putting that into full-time equivalents. Yeah, they're just saying if you got 2 people working 20 hours a week, that's really what, 1 FTE, 1 full-time equivalent. If you have that going on in your organization, that was never really that big of an issue where I've worked. Look at engineering measurements, bill of material accuracy, BOM, which is usually the materials manager or supply chain. A lot of times they have really responsibility for that. But again, you're looking at it as well. But bill of material accuracy in conjunction with engineering of setting up how much, let's take, for example, if you're making a certain type of battery, how much lead goes into that battery, right? And just a small amount can make a big difference. 1/10 of a pound on 7 million batteries is what, 700,000 pounds? All right, that can make a big difference. Then you start multiplying that by the cost per pound of lead. Bill of material accuracy, labor routing accuracy. I mean, his job as an IE was never ending in making sure that the standards were accurate on the floor. And maybe you implement some new equipment that changes the standard, he has to be on top of that. Ratio of the actual to target cost, warranty claims percentage. With the engineering, if they're setting this up, are they causing scrap, unrecognized scrap, or scrap that this somehow finds its way through the system? Maybe the battery, when it's tested finally before it goes to a particular location, looks great, and then 2 months later, the thing's dead for some reason. Maybe too much vibration in the car, or when it's exposed to heat, it just had a weak weld. It's unlimited, the things that can occur there. And so you see, these are all non-financial measures that they're here in a controller handbook, right? Which is really what this is. This text is really a controller handbook. Logistics, measurements there. Obsolete inventory, you know, that's one of the first things that the Big Four auditor would come in and ask me when we were going through the physical inventory while it was going on, because there was always some extra time there. The first thing would ask me, Joel, do you have any slow moving or obsolete inventory? Of course not. That was always what they asked. And you should have procedures in place that allows you to get that off your books. As I've talked about in prior chapters, remember the MDRA, Material Disposal Request Authorization? I could fill that out for something that sit on my shelves too long because the corporate office had us billed to a corporate production plan that never panned out as far as in marketing and sales. And so I could fill that out, send that in, they would give me approval. I could write that product off and they would give me credit. It didn't go against Bristol's books. It went against a corporate level books. So very important there. Obsolete inventory, inventory accuracy. Production measurements on the next page. We could talk a lot about all of these. Constraint utilization, bottleneck. Did you read, hopefully you read the story about Herbie, theory of constraints, right? Very simple there. Very important. Average equipment setup time, down there halfway down or at the bottom of the screen there. Average equipment setup time. And then scrap percentage at the bottom, huge. That was always huge, scrap percentage. And setting up your budget and think, well, why does that make that much difference? It does. Scrap percentage over time, and probably your MRO spending, things like this maintenance repair and anything environmental for us were always the three biggest costs. As much as everybody talked about direct labor, that pretty much you manage your direct labor based on the standards. Very straightforward to do that. But these other things are, they can really get out of control. All right, then on 373, talk about trends. That was the other part. You know, I talked about horizontal and vertical analysis. What's trend analysis? That's like taking a base year and going, it's really sort of a subset of horizontal analysis. Trend analysis is just taking a base year and then comparing, how did you do in, let's say you had a base year of 2017. How'd you do in 2018? How'd you do in 2019? How are you doing in 2020? And all that is related to the base year as far as increase or decrease dollar-wise and in percentages to the base year. You know, horizontal analysis by itself is just year over year over year. I'm not sure how important trend is other than looking at, I mean, you have good and bad years based on things that happen, like this year. 2020 is going to be a year most companies want to kind of ignore, but it is what it is, and that's going to be part of their analysis for trend analysis. Trend of cost of freight, trend of cost of sales, sales quota, It's unlimited, the number of things here. I keep saying unlimited. I guess it is limited, but there's a lot that goes on that I think a lot of times we think is not relevant for controllers. Look at the one down there, the third one from the bottom. Trend of the accuracy of inventory, bill of material, and labor routing information. These three items are all required at levels of 98% accuracy or above in order to operate in materials requirement planning. Accurate bills and material required for just-in-time. That's if you have a just-in-time system. Ratio of overhead to production labor. Overhead, that big bucket that sometimes gets ignored. Nobody knows what's going on in it. It's not controlled or managed like it should be. Things like MRO, indirect labor, because you don't have labor standards, routings. The labor routings standards are what? Direct labor. So things like MRO spend, managed repair operation spend, indirect labor. Of course, your electricity, it's a big one. Well, at least it was for Exxon and Bristol. Then on page 376, interrelationship. I'm just going to kind of go on through that since I've been talking here for at least a half hour. So that's going to bring us to chapter 21, financial analysis. Now, you're doing a lot of this in seminar on financial accounting. At least that's what you told me. Last time we met there in what, early March. But we'll go ahead and kind of just look at the high spots in this chapter. It's a good one. It may even help you in what you're doing in seminar and financial, right? Full year presentation of financials. I can't see the left side. I guess it's too big. There's my arrow key to go to the left. Well, that wasn't it. Well, it's down there at the bottom. So over on the left side, you can see the various, in this case is, well, no, there's not. I'm on the wrong page. All right, so this is page 380. There is no list, so you are seeing the full thing. Well, there's the page number, 380. All right. Everybody likes charts. It looks like Excel charts, doesn't it? Monthly cash balances, revenue. Then once you get this set up, it's usually just download it and hit the enter key, right? Link everything up. There's your ratios. Horizontal analysis. In some sense, it's horizontal and vertical, right? Look at their inventory turnover. And it really gets more complicated than just that. You really want to do inventory turnover by your SKU, stock keeping unit, SKU, especially on what you're selling that's sitting on your racks. That's where you want to obviously look at what's obsolete and what's not. And so this is big picture SKU, inventory turnover, but what about from a SKU level? Some are probably being, some of them might have a 20 inventory turnover and some of them might have a 2, right? So this is just high level. Revenue per employee, how many employees did you have? Did a lot of this stuff at Exxon and Lear. Everybody's wanting to look at the numbers. All right, let's continue on. Analyzing working capital. They make a good point there. It says you can experience excellent profitability and still go bankrupt for lack of cash. Yeah, if you're spending all your cash on maybe interest expense or you're over investing in assets, it can be pretty tight. Or as they point out here, you got increase in accounts receivable, which has been booked as sales, right? Revenue. So you got higher income, but until you get to cash, it doesn't matter. And if you're making sales to less than desirable clients that don't pay their bills, that's a problem. Or maybe you're buying too much inventory and you end up writing off a lot of that inventory at some point. Or maybe you haven't written it off and you still got what? That inventory sitting on your assets that should be in cost of goods sold as scrap or obsolete inventory. Or maybe you're paying your accounts payable quicker than you're getting your cash in from accounts receivable. You got to balance those two. So analyzing working capital is a big part, high level of what you need to do as a controller and financial leader of your organization. Then on page 386, they do some great analysis here. That's why I would encourage you to keep this book with you in your career as sort of a desk manual. Accounts receivable, poor collection efforts, poor credit standards. I mean, sales will sell to anybody they can if they're getting a commission. Accounts receivable, delivery problems. To the customer, accounts receivable, maybe there's billing problems. That's the next one down there. Delivery problems, billing problems at the bottom of the page. What about inventory? Excessive purchasing, excessive building as well, overbuilding your product, running more product through than what's required. An effective company will always have a pull system based on order. So based on the order tells you what you should build through the system. It gets more complicated if you got something that takes 7 days to build from start to finish, but they should know based on previous historical estimates or facts of what the actual demand is. But don't just continue to run big batches or lots of material and then sit it on the racks. That's just not, that's excessive purchasing or that's excessive building. Says excessive quantities forecast. I mean, nobody wants to stock out, right? You don't want to run out. There it is, excessive quantities produced. So all this is important, and that's why you have to have professionals in your organization that know each of their respective functions. But you as controller should have a good conceptual view of everything and how it's integrated and works together. Probably didn't talk about economic order quantities. I don't know if that's still talked about in business. EOQ, what's the best amount to buy? Look at top of page 388. By there, inventory, premature engineering changes, ECO, engineering change orders. That goes on all the time where they're trying to either take product or material out of whatever it is you're making. Less material going in means what? A higher degree of a both gross margin and contribution margin. The ECOs, engineering change orders, are very important. Inventory distribution issues. What about accounts payable? ECCT never took early payment discounts. In some ways, it was kind of stupid. At the same time, if they're going to delay paying for 60 days, because if you had payment terms of 210 net 30, what does that tell you? 210 net 30. You get a 2% discount if you pay the bill within 10 days. That's pretty good. Or what? It's due in 30 days. So what is that? You're getting a 2% return on your money for what? 20 days? Well, how many 20-day periods are there in a year? 360 divided by 20. Going from day 10 to day 30 when it's due. Was that 18 periods? So 18 times 2%, you're getting a 36% return on your money. It sounds pretty good. So you would take the discounts. But what if you're not going to pay the bill for 60 days, right? Then it starts changing, doesn't it? So 60 days minus 10 is what, 50? How many 50-day periods are there in 360? Six or something. And even that times 2%, you're looking at what, 13% return on your, which is better, but still, of course, some of ECCT's debt was 13, 14% because it was so highly leveraged and was a bad credit risk and what they were paying on their bonds and so forth. But use of early payment discounts, look what it says. The funding available from accounts payable would decline as the controller elects to take all early payment discounts that are allowed by suppliers. Although this is for a good cause, result in reduced expense on items purchased for which deduction or pay also means the company will have a smaller float on the money being loaned to be hit or being loaned to it by suppliers. You got to know what your corporate cost of capital is. And I'm sure that's the reason ECCT didn't take discounts. They weren't going to pay vendor terms of 2% 10 net 30. They were going to make it 60, maybe even 90 days. And so then 90 days versus what? 2% on 10, what is that, 80 days? I mean, 80-day periods are there in 360? 4.5 maybe? So 4.5 times 2%, then you're 9%. Well, if ECCT's capital structure or credit structure was such that you were paying more than that, then that's why they didn't take discounts. At the time, I didn't fully understand what they were doing, but I do now. All right, then on page 390, Oops. Sample working capital analysis. Down at the bottom, they use some terminology there, which I was just talking about. And you can read this on your own since I need to get going here and get to those two other exercises. Look what it says down there in the bullet points. Talking about engineering change orders. ECO, very important. You'll encounter that in your career. What the engineers are doing to try to improve the process, improve the product. Reverse the engineering change order. Look what else is stop production. These are the solutions to what's being proposed there on this working capital analysis. It says their investment increased by 1.2 million in the past 3 months. Conversion to a new motor for roto-wash clothes. Also, the production part made an excessively long production run, right? You don't just run stuff out in a big batch because you got the material. Excess finished goods inventory, 300,000. Interesting stuff, but look at what the recommendations are. Stop production for 2 months, reverse the ECO, put an immediate credit hold on credit appliance stores until that overamount, 500,000 overdue amount is paid. Stop taking early payment discounts of all kinds so the working capital investment allows enough excess cash flow to be taken in again. That's a good little exercise. I would encourage you to read that, 21.5. All right. And then we get into 391, analyzing financing options. We talked about this last time. What to say there in the middle of the page. There are 2 basic types of funding, debt and equity. Debt is agreement to pay interest on a loan sum, which eventually must be returned to the creditor, right? They want their interest payments and they want their principal back. Well, what about stock? You don't have to pay anything back. Of course, you're paying dividends. The interest expense on the bonds is tax deductible, but the dividends are not. So what do you think when you start talking about debt versus equity in your capital structure? I think we hit on that last time. Look what it says down there at the bottom of page 392. When considering which of these options to recommend, the controller must understand the cost and risk of each type of funding. Except for the most highly leveraged situations like an Exide, the incremental cost of debt is always less than the cost of equity. This is because the interest payments to lenders are tax deductible, which essentially reduce the cost of debt, whereas dividend payments to the holders of common stock are not. Lenders take no ownership interest in the company, so there's no risk there that they will unseat the management, meaning the board of directors and the management. This is not at all the case if the company sells common stock. However, there's risk in procuring too much debt because the amount of interest payments can eat up all excess cash flow. All right, then the next page, summary of financing option advantages and disadvantages. What about leasing? You know, used to be operating leases and capital leases. That's changed now. Everything that's 1 year or longer is a capital lease. It used to be you had the 4-way test. Remember that? And operating leases are more expensive, but companies like to do that prior to 2019, January 2019, companies like to do that because it was off balance sheet financing. You had the commitment that you had in a purchase order to lease equipment was never on your books. Remember the whole purchase commitment that a company has? It's not an obligation as defined by bean counters that you put that on your books, right? But now that's changed. The obligation is there now. The capital asset or the asset liability model says, if it's more than 1 year, I've got to put that on my books as an asset to be depreciated and as a liability that I'm going to pay down as I pay those monthly payments. The operating lease, which is what he's talking about here, is something that's just being expensed like rent expense every month. Very expensive. So that's changed. Just thought I'd throw that out there. when you had me in 30/20, you probably did it the old-fashioned way, which you had the four-way test. Is it a bargain purchase? Does title pass at the end? Is the lease term 75% or more of the economic life? And then the fourth one was, is the present value of your minimum lease payments and residual value that you might pay, is the present value of that greater than or equal to 90% of the fair market value when you take possession of that equipment? There's one of those four, it was a capital lease. So companies always try to get around that and make an operating lease. But that's not the case anymore. They took that away from companies so that all this stuff is on the balance sheet now. That was these large companies, that was a huge task to take all this stuff and put it on your books, because it's not just on new stuff. There had to be a plan to take what's out there that you're leasing and migrate that onto your books as an asset liability. All right. Services, profitability analysis. All of this is stuff that you look at really from, it's surprising that it's in here as accounting text, but really it's very relevant. And I'm skipping through that part, but let's look at the throughput analysis model. Probably the last thing I look at before I look at the additional assignment. The throughput analysis model. You need to read that, and what they're saying here, they're going to compare, I think, 4 types of products. There it is, 4 types of products that a company can sell. 19-inch color television. Well, let's go to the next page. There it is. 19-inch TV, 32-inch LCD, 50-inch high def, and 42-inch plasma. And what they show there is the throughput, right? You hear me talk about throughput a lot. What's the constraint as far as time? He's working on units of scheduled production, constraint utilization, and throughput per product. And so they've already done a lot of the work somewhere else, and they've just put it out here. But if you read through this, it'll tell you that for that first one, for example, that 19-inch color TV sells for $100. The associated direct materials of $67.56, right, is $32.44. The price and direct material costs are not shown in this exhibit. They're only inferred. So the throughput is $32.44. And it also says you got to divide that by how much is the processing time per unit. And it's 4 minutes processing time per unit. It states it right there. And so that's how you get from $32.44 down to $8.11 on the next page. And so there it is. And what they're trying to show you is, and this column here is, what's the highest level of throughput per minute of constraint. You don't have unlimited time. You've got these competing products. Of course, the other side of this is what's the demand. They're sort of ignoring that, although they've shown the production should be demand, right? But it looks like they've got an equal amount of demand for each of these. So that 19-inch TV, $8.11 is in effect, that is your gross margin. Required constraint, 4 minutes. If they're going to schedule 500 and the utilization time is 2,000, they got 2,000 minutes available. And that says we're going to have throughput per product of 16,220. All right. Yeah. Look at the next one, 750, 621. So they've got these ranked from top to bottom, which one's really the most profitable. It's kind of surprising the TV, if you truly had demand for 500 of those, even though the price is cheap. Well, maybe they have some more information down here at the bottom. It's the top of the list. You can probably read that for yourself. But this is important, and it's a good exercise. You know, they go all the way down through this, all the way to page 399. Read those 3 pages for your own edification to show how this throughput per product total has been maximized by building more of what you have the greatest margin on, right? As long as you've got the demand from the market for it. But this is very important, how you need to rank things together. All right, continuing on. Page 401, they keep talking about TVs on here. This is interesting reading, and that's what's going to make you successful as a controller, is what is really taking your accounting skill, and you're not doing GAAP here, and because cost accounting, what you're doing with managerial accounting a lot of times is not, I mean, it's based on GAAP, but at the same time, it's not GAAP, and how you're trying to make decisions for your organization. So keep that in mind. All right, so let's go ahead and jump over to these other two exercises or handouts that I've got. Let me jump into the Deming. There it is, 14 points for management. This is a great couple of pages. In fact, I actually typed this up many years ago because it's so important. And it's not that I went out there and pulled from whatever he said. It's basically is a copy of what he's written there in his book, Out of the Crisis. I don't recommend reading too many books, but if you want to read a great book, read Out of the Crisis there by W. Edwards Deming. He passed away, I think, in the early 90s. He was 90 some years old. But he's the guy that went to Japan after World War II, along with the Dodge brothers and the banking and General Douglas MacArthur. There seemed like there's someone else that helped on the agricultural side to rebuild Japan, obviously after the 2 atomic bombs were dropped on Hiroshima and Nagasaki. I mean, they were, and been defeated in the war, they were destitute. And so they were welcoming any type of direction. And so that's what we did as a country, was to rebuild Japan, and they're one of our closest allies now. But the United States, I mean, you just took all these various car manufacturers and airplane manufacturers back in the early 40s, and they were retooled to make weapons of war very quickly. Of course, after that, then all the defense industry sprung up, all your Raytheons and I don't know what all the different ones, Lockheed. Of course, some of them do both. They're doing both defense contracting and stuff for just the general public. But all that sprang up after World War II. Well, the United States, you can imagine, we just saved the world from Japan and from the Germans. So how much are you going to listen to what anybody has to say? Well, you need to change what you're doing. Well, no, nobody listened. And then that's what happens. You rest on your laurels. That's a good point for each of us and each company, even today. You rest on your laurels, you're going to start what? Fading away. Company just recently, I say recently, the last 12 years or so, you know, it used to be everybody talked about getting a BlackBerry. I had a BlackBerry when they first came out, probably 15, maybe 20 years ago. I don't remember exactly. BlackBerry, that was a wave of the future. That funny looking thing that was just like a PC in your hand. It was a phone, email, everything. But then after 2008, when other companies got involved, they made a better wheel, didn't they? People like Apple and so forth. And who has a BlackBerry now? Nobody. If companies have those, because they're dirt cheap, but the stock is nothing, very low. They may even file Chapter 11 at some point, but who would have thought that for BlackBerry? So you rest on your laurels, you're going to slowly decline because somebody else is nipping at your heels all the time. You have to constantly, that's what continuous process improvement is. That's what this is that Deming has. Using SPC, statistical process control, to drive improvements, not just what you think's going on, data-driven analysis. Very important. So let's quickly go through here. A lot of this sounds kind of vague, but think about it. Create constancy of purpose toward improvement. You need to have a unified effort in your company to move forward, or in your country as well, but just talking about for a company. Adopting a new philosophy. You're a new economic age, and this was written years ago. Every day is a new economic age. We're in that right now. There's going to be companies that don't make it through what we're going through right now, and here in spring of 2020. They won't come out on the other side because of the loss of their customers, and they won't come back. People will start doing something else. Who knows what that's going to look like, but the strong survive and the weak don't. That's just the way it is, even if you got corporate bailouts or what. I don't think those bailouts are what people think they're going to be. I think it's more of something that looks encouraging, but we'll see. Cease dependence on, this is a big one, number 3, cease dependence on inspection to achieve quality. My dad worked in, he called it for years, quality control. He worked at Raytheon, but he worked for the federal government as a civil service employee. He and 2 or 3 others were there as federal government employees to oversee the quality assurance of the process. But they called it inspecting, right? Quality control. Now it's quality assurance. It used to be called audit. Now people say they're assurance right? For PwC or whoever it might be, they use that term instead of audit. It's like quality control. You can inspect quality in, doesn't mean you do away with inspection. Like I said, we inspected batteries on our docks that were going to Toyota, because if you didn't and they get bad product and they charge you $100,000 demurrage, you're going to make sure that what's on those trucks is inspected, right? But you want to build quality in all along the process, from the very beginning to the very end. Build quality in. Ford used to have that commercial, that Ford quality is job one. I mean, everybody, and most of these manufacturing facilities that make cars, that line is being controlled by a conveyor that's moving at a particular pace that the IE has decided. But every one of those employees working on that line has the opportunity to reach up and pull a big red handle that says, stop the line, there's something wrong with the quality of the product. That's building quality in all along the process. And the quicker you catch it, the less expensive it is. Because you've probably learned in managerial accounting, as you're building product from whip to whip to whip as it goes through the process, it's like a snowball, right? Snowball of material, of labor and overhead that's getting applied. And that snowball gets bigger and bigger and bigger. Well, if you don't catch it till it's out here, you got a huge snowball to deal with, don't you? You do. You want to catch it as early as possible. And that's what he's saying here. Number 4, in the practice of awarding business on the basis of price tag, minimize total costs. Move toward a single supplier. Some people would argue that's probably not wise. You need to have multiple suppliers, but he is stressing long-term relationship of loyalty and trust. Cost is important, but that's not the overall end all. Improve constantly and forever the system of production and service. Again, you rest on your laurels, you're going to fall away. You're going to find that. You get your CPA or CMA, you still got to do 30 to 40 hours of CPE credit a year. You should constantly be reading about things, improving your knowledge, right? And I read a quote the other day. It said, we should know something about everything, right? We should know something about everything and everything about something. Well, whatever you choose that something to be, if it's accounting or whatever, you should be an expert in that. I think it was Ben Franklin that said we should be a jack of all trades. And this is always misquoted. People say it's jack of all trades, master of none. But from what I've read, Ben Franklin said we should be a jack of all trades, master of one, right? You should be an expert at something, whatever that might be. So you should strive to be an expert and never give up learning, which is what he's saying here. And you'll see that in some of these other 14 points. I would encourage you to print this out and keep it handy. This is what successful leaders and managers do. Institute training on the job. Training on the job. Nobody ever gets enough training wherever you're at. Institute leadership. See point 12, and well, you don't have chapter 8. If you get the book, you'll have chapter 8. The aim of supervision should be to help people and machines and gadgets to do a better job. Supervision management is in need of overhaul, as well as supervision of production workers. You want leaders. You want people who tell you what's going on. And that production line, if they're out there 8 hours a day looking at something, they're the experts. They're the master of one. Listen to them. Your job as a supervisor, manager, CFO, CEO, is that you don't know everybody's job and everything about everything. You got to have good people around you if you're going to be successful and if your company's going to be successful. Which brings up the next part, number 8, drive out fear so everyone can work effectively. Drive out fear. That's chapter 3. It's a beginning, right? We should drive out fear. Problem is, if you start working for a company where there's fear throughout, what's going to happen? Well, you're going to be afraid to hire good people under you for fear they're going to what? Kick you out because you make more and then elevate them, or they're going to become more knowledgeable and more valuable. That's not a good company to work for. That's a terrific reason to find another employer. If you get in a situation where you can tell there's just fear throughout the organization, people don't share information, get out, find a job where people work together, because there are companies like that. And that's what he's saying there in number 8. Number 9, break down barriers between departments. Learn what's going on in your organization. Everybody needs to work together, and you as a controller can have a big part in that because it's all about numbers, right? Eliminate slogans. exhortations and targets. 0 defects. How many times have I heard that? What's 0 defects? Somebody tells you 0 defects. Well, no way I'm ever going to reach that, so I'll do my best, but that's it. 0 defects. You should have, if you're going to have targets, and he says you shouldn't even have targets. Now, you may have production targets, but those targets should be based on your industrial engineer, what he or she has set forth that are attainable. You should have attainable targets, is what he's saying. Work standards, quotas, substitute leadership. He's just saying that that shouldn't be the end all. I got to make 500 widgets by the end of the day or else I'm in trouble. So I'm going to put 500 on those pallets one way or another. He's saying you really should allow those employees to tell you what's wrong with something. You know, we looked at that last week or week before, that example of the engineer, the IE that became a supervisor that didn't want to become a supervisor, working for a guy that didn't know what he was talking about. And then it was worse than when it began. That's a great example. You got to go back and read that. But that's exactly what Deming is talking about here. Remove barriers that rob the hourly worker of his right to pride of workmanship. Remove barriers like that, barriers that rob people in management and engineering the right to pride of workmanship. Institute a vigorous program of education and self-improvement. Always be willing to learn about, and it doesn't have to just be about your job, learn about all kinds of other things. I enjoy learning. I like history. Hated history in high school, but I like history. Know something about everything, right? Know something about everything. Doesn't mean you have to become an epidemiologist during this COVID-19, right? There's enough people out there that seem to think that they're an epidemiologist now, but learn enough about it to be able to make decisions for yourself and your family, right? That's where the onus is on anyway. Education, self-improvement is not just about becoming more knowledgeable in accounting and memorizing all the various regulations and so forth. I don't sit around and read journals of accountancy. I look to see what the new stuff is coming down the block and how I can relate that in a simplistic form for students. But learn self-improvement on anything. Put everybody in the company to work to accomplish the transformation. The transformation is everybody's job. Sort of a umbrella there at the end. So those are the 14 points. Now, he's also got what's called the 7 deadly diseases. And this was written years ago. Again, this is from the book, Out of the Crosses. I would encourage you to get a copy of that and read it. It's not that thick. It's written very straightforward, as it should be. What's the 7 deadly diseases? Lack of constancy of purpose, right? Going one way one week and one way the next. What's the flavor of the month for what we're doing with management and plans and methodologies? Emphasis on short-term profits, short-term thinking. Should be long-term. Fear led by unfriendly takeover. That was very popular back in the 80s when he probably wrote this. Evaluation, performance, merit, annual reviews. Hate them. Hate the annual. If you have to wait once a year to evaluate an employee, you've missed it. If you've got a problem with somebody, you should talk to them immediately. Managed by only visible figures, little or no consideration of figures. Excessive medical costs. Wow, he was a prophet, right? A management prophet, knowing what was coming, because it was cheap back then by today's standards. Excessive costs of liability swelled by lawyers that work on contingency fees. That's another good one. I was sending that to my nephew. He's in law school. All right, so let's look at this last item here, which is a spreadsheet. Hopefully you can still see that. And what I've got here is a budget, column C, D, and E, that's already been plugged for your various account titles. The variable percentage, if it's 100% variable, that means it's 0 fixed, right? If it's 25%, well, I don't have any training. If they're like that, no training budgeted here. If there, it's probably an indirect labor. If it's 65% there, indirect labor, right? Then it's 35% fixed, 65% variable, 35% fixed. That's what's considered. Let me make this larger. There we go. So 65% there is 35% fixed. Why is that important? You'll see. So let's look at the overview there first. It says that a divisional vice president of batteries are us, like my term there, because I just made this up. Your newly acquired MBA, I guess I need to change that to MAC. I was going to use this for my AMBA class, but then felt like I had too many other things I had them do. But this is something relevant for anybody who's got a master's level degree from a college in business. And so what I've got there are the actual amounts. This means that we're putting this together sort of at the end. You got the budget at the beginning. We're putting this together with knowledge at the end of the year what the actual expenditures were. So you need to take what's listed here and plug that in. You don't have to link it. If you want to, you can. That'd be even better. But your direct labor, plug that in over here under variance analysis. So, excuse me, under actual. So if that's supposed to, and I've forgot what that was, 5,500 and 3,300. So if I put 5,500 here, I'm not going to do the whole thing, and 3,300 there, those are my amounts. You want to do that on all of this, all the way down to the bottom and the actual, all right? All right. Also at the bottom here, we want to see our production volume. We were budgeted to do 1,378,000 and 4,797,000, what's called form, meaning putting acid in it. And the earned hours, which says what? That says that's how this thing should flex. These earned hours are based on your labor routing outings, labor routing hours should be 287,000 based on my assembly and based on my formation, because every department is driving. There's more than just those two departments, but those are the main ones that the others feed to. Those are the number of labor hours it should take to generate this product. What you need to do as well, because I'm skipping the population of the rest of these actuals, go back over here and down at the bottom, there it says assembled volume 1625 and 5,000. So I want to put 1625 and 5,000. You see how that earned hours is populating? 316. So you can see, in essence, my earned hours have gone from, I've actually earned 316,000 earned hours versus a budget of 287,000. So that's a percentage, that's an increase, right? The whole point of this spreadsheet is, well, what should my budget have been? You know what the static budget is? It's right here. My static budget says I've got $34,934,000 for that production plan, 1,378,000 and 4,797,000 of assembled and formed, with earned hours of 287. So what you want to do is populate the actual, then come back to the top, and really the only hard part that you have to do, you have to develop a formula there in flex budget that flexes this budget here, not the actual. You want to flex the budget here to be a new flex budget. So you're basically creating a new budget. How do you do that? Well, I'm not going to show you. I will tell you. You can go back and listen to this. What you want to do is take the percentage increase, which is what? Equal to 316 divided by 287, all right? 316 divided by 287, what is that? Is that about 10%? Equal to that. You don't have to do this. I'm just showing you the percentage. It's gone up about 10%, but you don't want to actually do that. You can if you want to factor that in. Well, what you want to do is use a formula, put a formula here that says equal to what's down there at the bottom, your actual earned hours divided by the budgeted earned hours, that 10% increase. You want to multiply that by what? 45.99. That was your original budget times what? 100%. That works great for just the ones at 100%. But what about one like this, the 65%? So you need a formula over here. It's going to be the same formula all the way down to the bottom. So let's look at that one, since it's sort of the capstone formula for this. So what you want to do is equal to cell F54 divided by cell C54, right? Times that times that plus what? Because that only takes care of the variable portion. plus 1 minus the variable cost, right? Because you're fixed times that. See, I told you I wasn't going to tell you a formula, and I just did, right? And so that formula should be the same formula there in column L all the way to the bottom. See what we're doing? You've got actuals here, and you want to know, how did I really do against the budget? I mean, I had 10% more volume. I should get 10% increase in my variable cost. Yeah, but your fix should stay the same, right? 35% of that, and you can come up with your own formula. I just told you one that came off the top of my head. 35% of that 3229 is fixed. It's not going to change. I mean, for purpose of this, I mean, obviously, if your volume was double, you probably have additional fixed costs, but this is considered the relevant range, 10% increase. So 35% of 3229 is not going to change, but 65% of that is going to increase by the difference between your earned hours actual and your earned hours budget. All right, I could talk forever about that and say the same thing 100 times. All right. I'm back. So that is longer than I thought it was going to take, but as for purposes of writing this week, your 5 pages again, the actual Excel sheet there, we'll just use that next week because I'll have one more topic to talk about. This is what, the 16th? Next week on the 23rd. But look at those last 3 chapters. I don't have any other assignments out there. I do have one that has to do with Enron, but I think the article I'm using on Enron, Michelle has already used in your seminar on financial, so I'm not, it's there for you to read if you want to. So next week, I won't have any external articles. We'll have 3 chapters. I'll go through very fast. And what you write about next week, this, for what I just did today in this video, you need to write 5 pages again, 1,700 words. Next week, we'll do those 3 chapters. And I want you to write 2 pages for those 3 chapters. You can do more if you want, and submit that Excel sheet that I just went over as your credit for your other 3 pages, since you've already done the other assignment as well for week 14. It has to do with that little test I gave you on earnings management, which I think there's still a couple of you need to turn that in. So that's what we'll do. And then, of course, the paper's due the following week. All right, well, I'll stop. If you have any questions, please email me. I'll be glad to help you. Hope you have a great day, and we'll talk again soon.